So just think of it like this. Your IRA cannot borrow or lend to certain persons. That include, you can't take money from your IRA and lend it to your spouse or lend it to your child or your parent and so forth. You can certainly partner with anyone. Your IRA can partner with anyone, but just be mindful of the rules in that you can take money from your IRA, lend it to yourself, or vice versa.
Hello, everyone, and welcome to the show. Are you ready to unlock a hidden world of financial opportunity? Imagine becoming a lender to your closest circle, friends, colleagues, and even relatives, earning interest on funds you wouldn't be using until retirement. Welcome to the realm of hard money lending through your self-directed IRA. In this episode, we have a true expert in the field, Renika Lightborn, who will guide us through the intricacies of this unique strategy. As a business development specialist for Advanta IRA, Renika educates clients and investors about self-directed IRAs to invest in real estate and other alternative assets. Renika actively directs her own retirement account as well. Welcome, Renika.
Thank you so much. I appreciate you allowing me to participate and have an Advanta as a guest on your show. Thank you.
Absolutely. Happy to have you. If you haven't already listened to Renika's first episode, she's been on the show before, please do so, because she goes over self-directed IRAs in a lot of detail, which helps you to understand how to lend through your self-directed IRA. But maybe, Renika, we can start with just very simply, what is a self-directed IRA?
Okay, yeah, great question. So a self-directed IRA just, very simply just means it's a powerful strategy or retirement. You can use your retirement plan, such as, a traditional IRA or Roth IRA to invest in alternative assets. Most people have their investments in stocks and bonds, but you can actually use your qualified retirement account to invest in alternative assets like private lending that we're going to be talking about today. So it just more so gives you greater control over your retirement funds. It gives you the ability to, build wealth at a much faster rate, possibly.
Yes, and what I tell people is it's always good to diversify, right? So you have your traditional IRA, and if you're able to, many people are able to, especially if you're self-employed, you're able to put that money into another IRA, and that's called a self-directed IRA. There's Roth IRAs, there's other types of IRAs, obviously, solo 401ks, but this is one of the vehicles that you can use to invest in real estate or other types of opportunities. So the first step is creating a self-directed IRA, and again, you can listen to that first podcast episode on the nuts and bolts on how to do that. But now let's talk about how to become a bank and actually lend your money, your IRA money, to other people so that you can enjoy interest payments that are tax deferred. So Renika got us to understand, what is hard money lending and what does this mean?
You just capped it off, pretty well. So that's exactly it. You get to use your IRA. Again, you're in control when it comes to self-direction, but you get to use your IRA to essentially act as the bank. And then, of course, as the bank, you get to, decide exactly how much you're willing to lend. You get to decide, what the terms or the rates are, between you and your borrower. You get to negotiate and say, well, this is exactly how much my IRA is willing to lend. This is the rate or the return I'm looking for. You get to decide if it's going to be more so a short-term type or transactional type loan, or is it going to be more so longer term, like a traditional mortgage type loan that's a little bit longer, 15 to 20 years or so. Essentially, again, you're just using those IRAs to act as the bank. And then, of course, you get to those income, those incomes of those earnings flows back into the retirement account, tax-free or tax deferred. So just think of it like this. Again, your IRA is actually the bank. For the account owner, again, you get to choose the terms of those, choose the terms for the loan, have those income flow back for you. For the borrower itself, they prefer to go through the private lending or the peer-to-peer lending. Sometimes it's referred to, just because they don't have to jump through so many red tapes like they would in a traditional institution like a bank or a mortgage brokerage company or so. So just more so, again, acting as the bank, and you have greater flexibility with what the terms of that loan would be.
Now, is there a limit to how much money you can lend?
No, there's no limit to how much money your IRA can lend. Obviously, you want to, and we'll probably touch on doing due diligence, but you just want to be mindful that whoever you're lending to, like, okay, you're making sure you're hedging your bets and protecting, if you're lending a large sum, but there's no restrictions on how much your IRA can actually lend out.
I'm sorry, can you repeat that last part? You said there are restrictions?
No, there's no restrictions in terms in terms of how much money your IRA can lend out.
Oh,
So
got
if
no.
you have $1 million in your IRA and you want to lend $1 million, if you're comfortable with that, as long as you have the notes or the terms structured in terms of, hey, this is exactly the terms of the loan or the note.
Okay. And what about the types of assets that you can lend to, or is there a restriction there?
So when it comes to self-direction as a whole, it's near limitless in terms of what you can invest in. Obviously, we just focus on private lending. There's restrictions in terms of what's called prohibited transaction, and that's something you want to be mindful of. More so, the IRA is not allowed to transact with certain persons who are considered disqualified. That's you as the account owner, that's your spouse, that's any lineal ascendants or descendants, or any business or entity that's owned or controlled by a disqualified person. So just think of it like this. Your IRA cannot borrow or lend to certain persons. That include, you can't take money from your IRA and lend it to your spouse or lend it to your child or your parent and so forth. You can certainly partner with anyone. Your IRA can partner with anyone, but just be mindful of the rules in that you can take money from your IRA, lend it to yourself, or vice versa.
Okay, so how close do the family members have to be? Immediate family members, or?
Your IRA can lend to sister, brother, cousin, friends and so forth. What you don't want to do, and not that people will do this, you don't want to take the money and lend it to sister who's not disqualified, and then have sister or brother turn around and lend it to your parents who are disqualified. So just be mindful of that, making sure that you own your retirement account, yes. You control your retirement account, yes. But you have to think of it as its own separate person, its own separate entity. So it's for later. So they don't want, the IRS don't want you to personally benefit from it today. So if you're lending it to your sister and sisters turn around and lend it to mom, then hey, what was your intent? Was your intent always to get it to mom?
Okay.
So,
you got to be mindful of the restrictions. So
yeah, just make sure it's for investment purposes only.
got it. Okay. And can it otherwise be any type of asset? Say you have a friend that's building a home and they need money, they need a loan to build a home. Can you lend them the money to build a single family home, for example?
Yes, you certainly can lend it out to a friend or an investor or whomever, or a syndicator that you're looking to partner into one of their deals with. But yes, you can, again, as long as you whether you draw it up yourself. We always encourage our clients to confer with their legal team to make sure that any note or agreement is legally drawn up, outlining exactly the terms of that loan. But yes, your IRA can loan it out to a friend who's looking for capital to build that single family home.
Okay. And got us through any other type of regulatory considerations, the due diligence you mentioned. What should we know about this?
So from a due diligence standpoint, in our role, we don't give our clients any tax, legal, or investment advice, but we, kind of help you dot those I's, cross those T's in terms of making sure that if you do make an investment in the IRA, it's done in compliance with the IRS rules. From a due diligence standpoint, you want to make sure that, you've done your due diligence and that you've reviewed whatever investment you want to make or whoever you're lending to or investing with, to make sure that you're comfortable with that, like meaning, hey, is this a fix and flipper? Like, okay, have they done fix and flip in the past? What are their track record? You want to make sure that if whatever they say they're going to do, it's actually done, because you want to be able to be mindful of there's risk involved with every investment. So if somebody doesn't do what they're supposed to, then essentially your IRA, the funds that you're lending, could be at risk. So you want to make sure it's there's secured notes and there's unsecured notes. So obviously secured notes is tied to, a tangible asset. Most cases it's real estate. So you want to make sure that when you invest, it's tied to an asset to, your IRA can possibly take possession of if it needs to, or it can liquidate to make sure that, it's made whole.
Okay. So in this particular example that I just came up with, a friend lending to another one to build a single family home, say they go through the due diligence, they go through all the regulations, and it makes sense to them. What's the next step? How are they able to go from there to setting up an agreement and structuring the hard money lending deal and lending the funds?
So the account owner, they have their account, the account is funded. In this case, they work with their advanced account manager to be able to send the money to that borrower where it needs to go. But before that, obviously, again, have your legal team or whatever paperwork that's needed in terms of outlining exactly, hey, this is the amount that's going to be borrowed. This is the interest rate. This is the term of the loan. If there's equity participation on a deal, in that case, in your example, it's not, but also too, what's the payment due date? And what's the delivery address, meaning where the borrower is going to send the funds back, get that appropriate paperwork back to Advanta. And then, of course, we work with you to get consent. Thereafter, you can have the money wired or a check express over to that borrower. So the process is pretty straightforward. Once your account is open and funded, and you give the direction to say, hey, my IRA is, lending X amount of dollars to John Doe or whomever, just have the paperwork to outline exactly the terms of that agreement.
Okay. And are there any limitations in interest rates, term length, anything like that?
So there's, for interest rate, you want to make sure it's at fair market value, meaning, again, if you're lending to a friend and the average or the current rate is 10% or 7%, you don't want to have your IRA lent to them at 1 or 2%. At that point, you're just being a good friend. So you want to make sure it's at fair market rate. Also, too, there's something called usury, meaning again, if the fair market value or the fair market rate, is 10 to 12%, you don't want to do it at 25 or 30 because now that's usury. You're taking advantage. So just make sure that it's at fair market value.
Okay. And what about the term?
For the term, you can kind of outlaw, again, you have complete discretion. You get to decide like, hey, this is, a transactional, meaning, hey, it's 12 months or less, or this is going to be a longer term, whether it's, 5 years, 10 years, 30 years, however, you have complete autonomy in terms of the terms of that agreement.
Okay. And then what about tax consequences?
So there's no tax consequences. The income from that or the earnings or the profits flows back into the retirement account, tax deferred. And then, of course, if it's a Roth account, once you've reached that retirement age and, if you've had that Roth account for 5 years, it's tax free. So there's no restrictions there.
Okay. And what about the UBIT taxes that we often hear about? Are you subject to those with this type of structure?
So with UBIT, unrelated business income tax, it more so applies to business income and not necessarily investment income. It could apply to private equity type investments. So this is where you again want to confer with your CPA or tax advisor. UDFI tax, I know sometimes is used interchangeably when it comes to specifically real estate, unrelated debt finance income. But in this scenario, it's possible if UBIT does apply, then of course this is where you want to consult with your CPA. I know a lot of investors, even if UBIT does apply, if the numbers make sense in terms of the deal, they still do it. So don't let that be a deterrent from you actually making the investment.
Got it. Okay. And what about advertising as a lender? I mean, are there restrictions in doing that? Like say somebody was like, oh, I want to post this on Facebook or social media that I am willing to lend, at this interest rate to someone that's doing this type of project. Are there limitations there?
Possibly. I don't know of clients that do that. More so, I don't want to get down the rabbit hole of SEC regulations in terms of guarantee returns or type of returns that you're looking for. But a lot of our investors, they're part of real estate groups or REIA groups, and they typically kind of network within those groups, and then they find opportunities. Meaning, hey, my IRA, I have 20,000. I'm willing to lend it at X amount. I'm willing to lend X amount of dollars at this rate. So I don't know about publicly disclosing it on social media platforms.
Okay, all right, but like most people do this within their close.
Yeah, because again, you want to. There's risk with every investment, but it's you can kind of help mitigate if you're a part of a local REIA group and you're networking, and these are the people that you see on a weekly or monthly basis, meaning, hey, I know their track record, I know projects that they've particularly done, or I can confer or talk with other investors that they have partnered with and so forth. So,
okay, my next question, Renika, is if you lend to a colleague, a friend, at let's just say 6% interest rate, as far as your friend is concerned, are there any tax disadvantages or issues or concerns or regulations that he has to be cognizant of because it's coming from a self-directed IRA?
There's no tax liabilities, obviously, for the lender. They're just, again, those incomes flow back to their retirement account, tax-free, tax deferred. From the borrower, as long as they're maintaining whatever agreement that they have in place.
So in essence, what you're saying is basically the lender has to abide by the regulations that we just discussed
for the IRA.
But the borrower really just treats this like a standard loan. like from a bank, for example. It's the same type of situation
Yeah.
where they have to pay back, the principal and interest and what have you, the same as they would a typical loan.
For the actual borrower themselves, they're just treating it as treating it as another loan that they would simply repay back those interests and those the actual principals back to that particular lender's that IRA lender.
Okay, got it. Okay, so this is incredibly fascinating because it really opens my eyes to a new possibility, a new way to diversify. Maybe it's even a safer way to diversify your IRA because you're not necessarily investing in equity, you're investing in debt, and debt is inherently less risky than equity. But let's talk about risk briefly. Like, tell us ways that we can guide people to help mitigate risk.
Well, obviously, some of the things that you want to be mindful of is making sure, again, you understand and know who you're investing with, but also too investing in secured assets, meaning it's secured by, secured by a tangible asset. Most times with our clients, if they're private lending, it's secured by some type of real estate. So that's a great way to mitigate those risks compared to an unsecured note. Other things to be mindful of, again, we know with private lending over time, it can be more so a very low maintenance type of asset, as long as maybe it's a repeat borrower that you're investing with. So just over time, again, finding those investors or those borrowers that you like and trust that's going to do what they're supposed to.
Excellent. Yeah, and I think that sounds super important. I mean, it's same as any type of investment where you really understand, the sponsor, the borrower in this example, where they're coming from, the type of asset that they are investing in, and you're lending to them based on that trust and that relationship. So like any type of investment, very important to do that. So this is very interesting. Let's go through some case studies, or maybe one or two case studies that you have that describe people doing this and how they did it, and how it looks like.
Okay, I don't know if you can see my screen. Just bear with me.
Sure. To those of you that are watching this on YouTube, Renika is going to share her screen, so you can take a look at that. But if you're just listening, we'll describe it in detail.
Okay, just bear with me one moment. So can you see my screen?
Yes.
All right, so in this case, we're going to be talking, this is case study number 2. Typically, if I were doing a longer presentation, I would go through all of them, but this one's just more so equity participation. Again, there's different types of loans, private lending, and one of them include equity participation. Again, I think I touched on, whether it's a transactional type of private lending, or more so the traditional mortgage, or it's, you're originating or doing originating a new note or buying a partial note. In this case, we're specifically just talking about equity participation on a deal. Let's see if I can get my screen to move ahead. So in this case, we have Andrea and Steve. Again, Andrea has about $150,000 in her retirement account, and Steve, he's part of a IRA group. He's a local flicks and flipper, and he's looking to do his next project. So Andrea, she meets Steve at the IRA group, and she's wanting to put her money specifically and work in real estate. In this case, she's responsible for doing her due diligence, meaning, finding out, checking to make sure that, Steve is who he is and can do what he says he's going to do. So they both agree that they want to partner together. And in this scenario specifically, Steve agrees to use the property as collateral, again, just to help mitigate those concerns that Andrea may have about lending her IRA funds. And Andrea agrees to the loan. She agrees to the term loans in terms of the amount that she's willing to lend, the interest rate returns, and then of course she has her the paperwork drawn up. So first and foremost, in this case, her IRA lends out $125,000 over to Steve so he can go and purchase, rehab the property. In this case, they agreed to a 5% interest payment. And then, of course, because she wants to do equity participation, she wants to participate in the upside of that project. He agreed that, her IRA is going to get a third of the profits. In this case, it's going to be a 2-year balloon note. And then, of course, during that time, that rehab time, Andrea's IRA is getting those monthly income of $520. And in this scenario, her IRA is in first position. So meaning if Steve doesn't do what he's supposed to do, her IRA can ultimately take possession of that property. And then, of course, Andrea works with her attorney, her legal team, to get the paperwork drawn up. She provides that copy over to Advanta as the self-directed IRA custodian. We read it, she reads and approves everything. And then, of course, Advanta sends the funds over to Steve to do it, to actually work on that project. Advanta holds on to that original note agreement. And then, of course, in this case, after some time, Steve does what he's supposed to do. So he's going to go ahead and request a payoff amount from Andrea's IRA. In this case, he's going to sell a property for $200,000. After all of the closing costs, he's again requests that he pay off what he owes Andrea's IRA. And then, of course, Andrea, she's working with a loan servicer who provides that payoff letter. And then, of course, in this case, ultimately, at the end of that transaction, Andrea's IRA is repaid the initial principal, which is $125,000. During that rehab tenure, her IRA actually received $3,000 in those, monthly income. And then because she negotiated equity participation after he sold the property, her IRA is going to get, $25,000 of that, the sale of the property. So in total, her earnings is her IRA earnings is $28,000. And Steve, he's pretty happy with the deal because again, he didn't have to go to a traditional bank in terms of jump through all of the red tape or, the lengthy turnaround time. So he's able to repay back the original $125,000 to Andrea's IRA. He sold the property for $200,000, and then of course himself, after giving Andrea her interest payments and also her equity participation profits, he netted himself $47,000. So that's just one example of private lending in an IRA scenario.
Yeah, this is a great example because not only is Andrea in first position on that loan, she also has a share of equity. So she's really covered, in terms of her risk by being in first position. But then on top of that, she gets the equity participation, which is a great way to structure a deal. If you're able to do that and you get some of the equity participation, not only are you the debt provider, you're participating in the equity. So that's phenomenal. And with AI and Chat GPT, if you have, I would always say consult with your lender or your attorney rather. I always have to say that to see what, CYA type statement. But like, if you really trust the borrower, look up all these terms based on this last example, or even your home, and look at the terms of that term sheet when you borrowed money for your home. Put that all in Chat GPT, create a legal agreement, and you have one right there. So you could have a draft legal agreement right there. You structure it so that you're participating in the debt, and if it makes sense, participate in the equity. Both of you guys sign off on it. You have your money with Advanta IRA, and then once you have that signed document, Renika, it sounds like you just submit that to Advanta as the custodian, and will just facilitate the entire process. Do you guys actually look over the loan agreements as well and review them to make sure that they're correct, or is that up to the borrower and lender?
That's up to the borrower lender to outline against the term of the agreement. Advanta does check to make sure that those information, that those particular terms of the agreement is outlined in the actual paperwork. But we don't tell you, hey, you need to do, instead of doing 6%, you need to do 10% or anything like that. Again, we don't give our clients any tax, legal, or investment advice, but we do make sure the information that's essential to those paperwork are included.
Okay. And then you, as Advanta, a self-directed IRA custodian, would facilitate that transaction. The money would go from Advanta to the borrower. The borrower would then pay directly into the Advanta account, correct?
That's correct. They can, or if they're using a loan servicer, it'll flow back into the client's retirement account with us. And for our clients, they do have, access to an online portal. They also receive email notification anytime funds are deposited into their account. But yes, essentially, once the account owner, the IRA owner, gives the consent, Advanta send the funds where it needs to go. And then again, based on the terms, whether it's monthly income coming in or quarterly or at the end of the actual loan itself, those those principal and interest payments flow back into the retirement account.
And you mentioned a loan servicer. Can you tell us about that?
So that's not our expertise, but some service providers, some lenders prefer to work with professional companies that act as a loan servicer, or have the borrower, they may more so adhere. Well, I'm sorry.
They elect to go through the
just to kind of make sure they dot every I,
dot the I's, cross the T's, basically. Okay, so I would imagine you do that if there was a significant amount you're lending, like over. I mean, it's subjective, right? I mean, to everyone, it's different. But I would imagine if you're lending a lot more,
then you definitely want to make sure to put every safeguard, safeguards in place to make sure you're protecting your nest egg.
Got it. Okay. So if the borrower and the lender elect not to go through a servicer, the loan agreement would be signed and send it to you. Advanta would facilitate that the funds being transferred. That money could be paid back directly into the Advanta account in terms of principal and interest based on that loan agreement. Would the borrower and the lender have to tell you what is principal, what is interest? Like, how does that work?
So it's outlined in the actual agreement itself. Like, hey, just like the example that we gave, Andrea, she's lending 125,000, so we know that's the principal amount. And then of course the interest is, in this case it was 5%, so 5% based on how much she's lending, and the loan ended up being for 2 years. So over that 2-year time frame, Andrea's IRA received monthly checks of $520. So it could be a very similar structured. It doesn't have to be that way, but that's just
okay. So you would, so Advanta would in fact interpret that loan agreement and divvy up the funds based on that agreement itself.
Yeah. So however it's outlined. So if it's saying, hey, all of the funds coming in on a monthly basis is just interest payments, and then of course the principal is at the end of the actual loan itself.
Okay. And when this transaction is complete and that money is all that profit goes into the IRA account, that is all in the auspices of a self-directed IRA. It's tax deferred, correct?
That's correct. Yes.
Okay, great. And legal fees and due diligence fees and all that stuff, can that be taken out of the account as expenses for this transaction?
Yeah, as long as you can show that this is indeed an expense related to that investment, it's paid by the retirement account. So, whether it's paying for a legal fee or, type of servicer fee or anything like that, as long as you can show that that particular cost or expense was related to that investment, then yes, it has to be paid by the retirement account. And again, you can have Advanta pay those fees in accordance to your direction, meaning, hey, if there's an invoice or a bill to be paid, you can simply log into your online portal with us. I don't want to get down the rabbit hole, but there's something called check for control feature where a lot of more active investors, if they have that feature, then they just simply pay for those service fees directly out of the LLC bank account that's owned by the IRA.
Okay, got it. And just to clarify, and I know we discussed this before in terms of family members, relatives, things of that sort. I just want to verify what degree of separation, is there a rule as to what degree of separation has to be between family members, or just any type of relation you cannot do this?
No. So the only prohibited or disqualified persons is yourself as the IRA owner, your spouse. So, yourself, your spouse, any lineal ascendants or descendants, meaning parents, grandparents, children, grandchildren, any spouses of your children or grandchildren. So meaning your IRA can't take money, you can't take money from your IRA and lend it to your grandchild or your parent or so forth.
Okay.
That's the only, or any business or entity that's owned or controlled by one of those disqualified persons.
And did you say, you said siblings were okay?
Siblings are okay, yes. So you can certainly lend to your sibling. Again, if your IRA is lending, whatever amount, make sure it's at fair market value, meaning, hey, my IRA is lending you X amount, and then whatever you're going to repay my IRA, make sure it's at fair market value. So if interest rates right now is 7%, then don't give it to your sister or your brother for 0%, because at that point, you're just being a good sibling.
Right, exactly. Got it. Okay.
I do want to reference too, like
Sure.
even though your IRA can't transact with certain disqualified persons, your IRA can partner. So think of it like this: you can certainly take money from your IRA and land on a project, and your spouse or your sister, your parents or your grandparents can certainly also participate on that same project. Meaning you're both sitting on the same side of the table as buyers or lenders. You're not on the opposite side of the table.
Got it.
So it's not uncommon for family members to partner in on a deal.
Got it. Okay. And there are nuances to this, and if someone does make an error in this type of transaction, how would it be discovered? What's the auditing process? What is the consequence of making a mistake?
So unfortunately, in an IRA, it is it is pretty costly. Meaning, if you were to do something inadvertent, whether on purpose or by accident, if you were to do a prohibited transaction or take money from your IRA and lend it to your spouse, and the IRS finds out, then your IRA ceases to be an IRA at the beginning of that year. So meaning you would have to take those funds out and then pay any tax or taxes and penalties on that because of that transaction in an IRA. And a solo 401k, and a solo 401k is designed specifically for business entrepreneurs. You do have a little bit more flexibility, meaning your entire account is not jeopardized in that solo 401k. It's just that actual transaction itself. They'll give you some time to rectify that. But in an IRA, if you do a prohibited transaction, then it no longer is an IRA, and then you have to deal with the taxes and consequences of that.
Okay, and the way to get discovered is via an IRA
audit, yeah.
IRS audit, rather. Okay, got it. Well, this was very informative, Renika. I think this would be very helpful to many of our listeners. Is there anything that we did not discuss regarding hard money lending to your self-directed IRA that you want to comment on?
I just want to encourage. We've done a lot of webinars, and we have a lot of information on our website at advanceira.com, to where if you do need more information, you can certainly take a look at those videos, or check out our website, or you can certainly reach out to me and we can talk through your exact scenario. But the one thing I do want to kind of leave with your audience is, you have to. No one's going to be a better steward of your money than you. So you do want to, proactively get involved with self-directing your account. You don't have to know everything. Our role here at Advance is to help you, guide you through that process. We can go over the IRS rules and restrictions as many times as you want to or need to, but I just encourage you to, if this is something that you're not doing and you're able to, definitely you should start.
Yeah. This sounds like a great way to diversify. One more question I thought of as you were giving your concluding remarks there. Can you invest in other businesses?
You can invest in other businesses, but just be mindful that UBIT may apply, if your IRA is investing in a business. So for example, think of it like this: if your IRA is investing in, say, a gas station or a grocery store, then the net income from that, the profit generated could be subject to UBIT. But again, this is where you want to talk with your CPA or your tax advisor. And even if it is subject to UBIT, if the numbers for that deal, make sense, you still do the deal. So, but yes, you absolutely can take your IRA and use your IRA funds to invest in the likes of businesses. It's near limitless in terms of what you can invest in. There's only two things the IRS say you cannot invest in, and that's life insurance and collectibles. So everything outside of that is pretty much fair game.
Collectibles as far as baseball cards,
yeah,
souvenirs, things of that sort. Yeah, we discussed that last time as well. Okay, well, this was great. Thank you, Renika. Super informative. And if someone wants to talk to you or reach out to you and get more information, how can they do so?
So you can reach out to me, visit advanceira.com, or check me out on LinkedIn. Those are I'm on other social media, but typically LinkedIn, and then of course, advanceira.com.
Excellent. And as always, you can reach out to us at Viking Capital, vikingcapllc.com, anytime with any questions. Even if you have another investment that you're thinking about and want to run it by one of our members of the investor relations team to get their take on it, they're super knowledgeable about all types of things. Feel free to do so. Always happy to get more questions from our investors. Thank you so much, Renika. We'll have you back again, I'm sure.
Thank you so much. I appreciate that.
Thanks.